All right. So yesterday we got to take a look at cash and what we can do with or what we can have available as cash. So we talked about petty cash. And we also talked kind of slightly about cash registers. So today we're actually going to be focusing on what happens when we receive payment from our customers, because again, we do have options when it comes to receiving money from your customers. You can either receive from pure cash or you can create accounts with them. All right. So first off, let's go ahead and talk about what a receivable is. So if you don't collect cash and have a cash sales, right, your second option is to either have or create an account for your customers so then they can owe you. So essentially, it's kind of like having a store credit card. That's an example. That's going to be something for like a notes payable or an accounts payable. You give them 30 days, they pay you back. Okay. Now, of course, you're obviously going to, when you create the account receivable, you're collecting information such as their name, their address, even their social security. Okay. You're collecting that kind of information to see if they are willing and are able to owe you the money. Okay, you don't want to just give an account to anybody. You want to make sure that you run their credit score just to make sure that it is going to be that they are in terms of available, or they are eligible to even owe you the money. Okay, so that is going to be when you have an accounts receivable. Usually what happens is if you have if you do, I'm so sorry. If you do plan to have your customers owe you, there is a lot of assumptions that you have to also, that comes with it, a lot of consequences. So you can't expect that all your customers, when you have them placed on an account, if they are guaranteed to pay you back 100%. Okay, so there's a risk of making that executive decision to go ahead and have them owe you money. Okay, some customers are diligent and they pay everything either all at once, or they'll pay it in increments of however agreement that you've made. Say 10 months, 12 months, 30 months. And then you have those other customers that they may be paying you, every single month, but then one day something happens to them and that's where they can't afford to pay. So it comes with a lot of risk when you are choosing to have your customers owe you money. Now, also remember this too, you know, when you actually create an accounts receivable, not only do you have that, but you also have to put incentives, or you have to, if they miss their payments, you have to make some kind of company policy to be able to collect your debt. Okay. So this is where we're going to be talking about the allowance for doubtful accounts. So for when those days where you do have your customers, right, when they do fault on their payment, we have this called allowance for doubtful accounts account. Okay, so what this essentially does is when your customers fail to make their payments, you actually are going to take their amount that they owe you and you're going to place it in this little placeholder called the allowance for doubtful accounts. Now, that's obviously within context as well, right? You can't just assume that the first payment, if they miss the first, or if they made their first couple payments and then all of a sudden they forgot to make a payment, you can't assume that you can't just put it right into allowance for doubtful accounts right away. It's something that you have to exhaust for quite a while. If you're noticing that this customer, they made a couple payments and then all of a sudden they stopped making payments, and you're noticing, hey, why isn't this person paying? And you keep throwing notifications, finding them, sending them a bunch of late fees and whatnot, and they're still not responding. That's when you can go ahead and safely assume that you need to place this on the allowance for doubtful accounts account. Okay. Reason being is because the allowance for doubtful accounts is, again, essentially it's a contra account. So make sure you know that it's a contra account to accounts receivable. But it's also, you can use the contra account as a placeholder. So the one thing you need to know here is that even though you place a portion of the money of the accounts receivable in the placeholder account for the allowance for doubtful accounts, just know that it's possible that one day that customer can come back and they will pay you back. All right, that's the assumption, and that is exactly why we need to use the allowance for doubtful accounts. So oftentimes the reasons why could be they went bankrupt, okay, or they just don't have enough money to pay this month, or anything could have happened. They lost their job, things like that, or they just don't have they just don't have or if they pay it on a credit card, they just don't pay their credit cards. So a lot of things can happen when it comes to for a customer to not pay. Anything can happen. They could be they lost their job, they don't have an income anymore. All right, and usually what happens when they do that is that when they file for bankruptcy, whoever the debt collector is, they have to go around and clean up all the debt that person owes. So that's just a few options that could possibly be a reason. All right. So when we're dealing with the allowance for doubtful accounts, you're going to know three things. You're going to know exactly who owes you the money and who didn't pay you. So that's very, very important. You're also going to know, say it again, Nilu. All right. You're also going to know how much they owe you, right? Because when we go into our fictitious business, you're going to actually realize that when the customer faults on their payment, you're going to look at their account. You're going to know exactly how much they owe you, and you're going to know, well, did they pay you all of it? You're going to know the exact amount. And then lastly, you should always know when it happens. So again, sometimes these things, again, they take time when it comes to noticing that a customer hasn't paid you in a while. So again, you can't assume, obviously the assumption is you can't assume the first time that they miss a payment is going to be an allowance for doubtful accounts. You have to wait till maybe the second or third payment after you sent them a reminder saying, hey, and you sent them a little late charge. And then you could go ahead and assume after that they could go into the allowance for doubtful accounts. So this is going to be during the period, okay? During the accounting period, because it can happen anytime within the given period, okay? So that's something that you need to also know as well, okay? So here's an example here for the for using the allowance for doubtful accounts. So here on December 16, Mr. Sanchez buys 100 of 100 toys on an account. Okay, he pays $20 every single month, so he made a monthly payment. And it started since January. Okay, so then on March 20th, he decides to file for bankruptcy. All right, and then he can no longer make the payments. So when in December happens, right, we're looking at the scenario where he made the sale originally, right? He placed it on an account and we sold him 100 toys, right? Or $100 worth of toys. So there it is, right? And then as every single month happens, we would reduce his accounts receivable because he's making payments. So he made a payment in January, he made a payment in February, and then all of a sudden in March he files for bankruptcy and he tells or some bank collectors will tell you that this person, whatever account they have, get rid of it because he filed for bankruptcy. So there you go. Since he made $40 payment so far, now he only owes me $60 because I looked it up on his account records. So now that if I know that I assume that he's no longer paying me back, he filed for bankruptcy, right? Now, here's the catch. Just because he filed for bankruptcy, that means there could be a possibility he could turn around and still make payments to me. All right? Just because you filed for bankruptcy, that doesn't really mean you're off the hook. It just limits your liability. So in this case, I move my section. So I move the $60 that Mr. Sanchez owes me from his $100 purchase in December. I move it into an account called Allowance for Doubtful Accounts. Okay? And I decrease my accounts receivable. Okay? So it's a contra account. Remember that, okay? It flows in the opposite direction. In this case, it's visible that it's a debit account, but when I tell you the next step, it becomes a credit account, okay? Because you do not stop here. This is, again, a placeholder for you to go ahead and assume that this person can no longer pay, but still has a possibility to pay, all right? So then we're going to talk about bad debt expense. So when you've reached at the end of your given accounting period, what happens is that if the amount in the allowance for doubtful accounts or your accounts receivable, you're going to make an estimated amount that you're going to assume that realistically you have a certain percentage where you know that your customers are not going to pay you back, guaranteed. Okay, and this is where we call bad debt expense. Okay, so when we typically do this, again, so any major corporation such as Walmart, who allows a million, even a billion people to have accounts, to have all the customers have some kind of an account, right? You can automatically assume that you're not going to be able to collect at least 5%. That's a corporate threshold. So that means every year for major corporations or major businesses, the government, the IRS, allows you to write off at least the maximum of 5% of debt. Okay, so that's huge, but then that's also bad because that's a huge loss you have to take. Imagine this: if people owe you $1 billion and you get to write off 5% of that, that's a lot of money. So think of it that way. But the IRS allows you to write that off. 5% is the maximum threshold that you can write off as a bad debt. So you're taking a loss because realistically, not every single person in your pool can afford to pay it. So yes, that's the huge risk of when you are doing business and you allow your customers to owe you on an account. So what happens here is that when you've exhausted, meaning you've spammed them, you spent 6 months sending them letters over and over and over again, and they just continue to refuse not to pay you. All right, with the exception of people who file bankruptcy, right? Again, when you've exhausted and you know this person's just absolutely not going to pay you back, that's where you could go ahead and safely assume, you hear my words, assume that you can write this person off. So what a bad debt expense is, it's going to be considered an adjustment entry. Why is it an adjustment entry? Because it happens at the end of a given period, okay? It doesn't happen during the year. It happens, typically it happens at the end of the year. You can do it every month, but just know that if it is every month, you can't write 5% every month. It has to be actually, never mind. You can do 5% every month, but that then realistically, it's more ideal if you do it every year 5%, because then honestly you're just hurting yourself more if you write off 5% every single month. So in this case, it is based on an estimated amount. It doesn't have to be 5%. It could be 2%. It could be whatever it is, 1% of sales. But usually the threshold or the recommended amount from IRS is the maximum of 5% per year. Okay. Now, of course, when we make this estimated amount, right, since it's based off of percentage, you don't know who is going to, who is the person that still owes you, right? Because it's going to be based on your total accounts receivable. You're just taking a blind percentage off of that amount, and you don't know who it is. And you don't know how much each person owes you. You're just taking an estimated amount. And then lastly, you don't know when these people are going to fault on their payments. You're just taking the assumption that it's a possibility that they're not going to pay you. So again, in this class, right, if all of you guys all owe me money, right, if I were to apply this bad debt expense, right, I'm going to say 1% of the class or that owes me money, I'm going to write them off. Do I know who? No. Do I know if Dan's going to fault on their payment next month? No. Do I know if Irina is not going to pay me at all, period? No, I don't know. I'm just making the assumption, and I'm making an estimated amount based on statistics that realistically, right, you all 7 of you are not going to realistically pay me. Okay, so that is what the assumption here. And again, it's an adjustment entry, and it happens usually at the end of a given period. Not during the year, not any random date. It happens usually at the end of a given period, and most commonly, it happens at the end of the month. At the end of the month or at the end of the year, either or. It could be quarterly as well. I just know that if you do monthly, same thing there. You don't want to write too much. Losses in 1 month. So that's why they recommend usually at the end of the year, when you have a collective amount or a longer list of clienteles and customers that you have them on account. It's better when you have a bigger picture. All right. So usually it's recommended at the end of the year. So again, you don't know who's going to owe you. You don't know who still owes you the money or who's going to fault their payments. You don't know how much they're going to fault on their payment. And you are not going to know when they will fault on the payment. So here, at the end of a given period, you're going to make an assumption, and you're going to make an estimated amount to write off that loss. Okay. So again, this is where where it makes sense when we're dealing with the allowance for doubtful accounts. Okay. So for here, there are 2 ways to write off bad debt. Okay. We have the direct write-off method, and we have the allowance method. The direct write-off method is only used for tax accountants only, for tax purposes only. And again, it is primarily geared towards for someone who works for the IRS. So when you're filing your taxes, this is where you can write off your debt. Okay, so in this case, we're looking at accounts receivable and a bad debt expense. So notice this here. Look at this. So look at this example here. When I journalize it, I'm directly taking it right out from the accounts receivable. Okay. Now, in this class, are we tax accountants?
No.
No, we're not. We're just the regular accountant, the regular general accountant. So what that means is you are never going to use this method, okay? Never, okay? Because it is for tax purposes only and it's for the tax accountant. So what you guys are going to be actually learning is going to be the allowance method. The allowance method here, right, is governed by GAAP, okay? And how it does is it's for regular accountants, general accountants, even day-to-day accountants. So if they're responsible for accounts receivable, this is for them, okay? And there are two ways or two methods included to write off the bad debt. So there's the balance sheet method and the income statement method, all right? So there are two ways to write off bad debt, okay? You have the direct write-off method, and then you have the allowance method. Then the allowance method breaks down into two more ways that you can indicate bad debt, okay? Now, when we are looking at this, we are going to look at both methods because I'm going to show you which one I guess is easier for you, okay? So the first one I'm going to be talking about is called the balance sheet method. So here's the example that you'll see. It is estimated that $25,000 of a $500,000 accounts receivable is uncollectible. All right? And there's a current debit balance of $5,000 in the allowance for doubtful accounts. All right? Journalize this adjustment. So notice this. If you remember from the previous slides earlier, right? When we created or when we had Mr. Sanchez owe us money, right? And then all of a sudden he stopped making payments. What did we do? We debited the allowance for a doubtful accounts right then and there. That happened during the period, okay? Now here we are reached the end of the period or the given period, and now we're making an assumption that right now I have a total balance of $5,000 in my allowance for doubtful accounts, and it's a debit balance, right? When we journalized it earlier, it was a debit. But here, I'm making a conclusion or making an assumption that I'm making an estimated amount that realistically, I'm not gonna get 25%. Or I'm sorry, I'm not gonna get 25,000. Not just 5,000. I'm not gonna get 25,000. So how we actually go ahead and do this is, again, we're looking here. Now notice this. I'm using my allowance for doubtful accounts and it's credited. Just exactly how we described it, right? Your allowance for doubtful accounts should always be the opposite of your accounts receivable, right? It's a contra account. So notice this here. It's exactly where I want it to be. It's in the credit side. Okay, and of course, all expenses are debited. Now, here is one method or one way that I teach so that it's not so you don't have to actually know the true meaning behind it. As long as you can recognize three things. The first thing is to recognize the estimated amount. Okay, so what's my estimated amount here?
25,000.
25,000. Good. Now the next thing is in what context is this 25,000 coming from? Here I say it's coming from my accounts receivable. Now that I recognize it comes from my accounts receivable, the next step is what kind of balance do I have in my allowance for doubtful accounts? If it's a debit balance, I'm going to add. If it's a credit balance, I'm going to subtract. Okay? Now, if you think it in context, right? your end goal is to be at 25,000. If you know that your allowance for doubtful accounts should have a credit balance at the end of the day. So right here, I need to get to 25,000 credit in my allowance for doubtful accounts. Right now, I have a $5,000 debit. Now, if I'm left 5,000, how much more do I need to get to a full 25,000 in the credit side? I would have to add those two numbers together, right? Because I have to go right 5,000 to get to zero, and then I have to go an additional 25,000 to get to my $25,000 dollar credit in my allowance for doubtful accounts. So in this case, your end goal is you need to have 25,000 in your allowance for doubtful accounts. So in this case, again, I have a debit balance. Because I recognize I have a debit balance, I need to add these numbers together. So my total is going to be $30,000 that I need to credit my allowance for doubtful accounts for, and I'm going to write off my bad debt expense for. Okay? All right? So let's go ahead and try the next one. All right? So if, it is estimated that $25,000 of a $500,000 accounts receivable is uncollectible, and I currently have a credit balance of $5,000 in my allowance of doubtful accounts, journalize this adjustment. So how much bad debt am I going to record?
20,000.
20,000. Okay. So here I gave it up to you in that little top right corner on what to do. This is the easiest way to memorize how to deal with bad debt expense. Okay. It's not very hard in this kind of scenario. You just need to be able to recognize the terminology that are being used and what is in the scenario. And I'm going to tell you this is going to be exactly identical to the wording is identical to the exam. I'm not going to give any more context in regards to this. It's always going to say a company estimates blah, 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 blah out of blah, 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 blah. Okay. It's going to look exactly like this. Okay. So that's the balance sheet method. Now here, I'm going to go ahead and show you the income statement method. So the income statement method, you only need to know two things. You just need to know the estimated amount. So here we see that it is estimated that $25,000 of $500,000 total credit sales is uncollectible. There is currently a debit balance of $5,000 in the allowance for doubtful accounts. Journalize this adjustment. So here, it's the same exact journal entry, right? You still have your bad debt expense and you still have your allowance for doubtful accounts. But however, this is the reason why when we use the income statement method, you only need to know one number and one number only. In this case, I just need to know the estimated number. And the key word here is if you see this word, the total credit sales, you're automatically going to say, boom, that's the number. Okay? Simple and easy. Now, there's a reason why when we make this estimate and when you see the word total credit sales is, when we go into the income statement, you don't see accounts receivable. You don't see your allowance for doubtful accounts. It doesn't exist in the income statement. All you see is your sales, right? You see all your sales, you see all your cost of goods sold, and you see all your expenses. So nowhere on that list will you ever see the allowance for doubtful accounts. So therefore, with that assumption, you're going to ignore that second half of that sentence. You don't care for if there's any type of balance in the allowance for doubtful accounts because it doesn't affect the income statement. So here we're automatically going to jump right in and look at the estimated amount and go and that's the number. Okay. So let's try it again. If there's estimated that 25,000 of a $50,000 total credit sales is uncollectible, and there is currently a credit balance of $5,000 in the allowance for doubtful accounts, journalize the adjustment. So what is the bad debt expense going to be this time?
25,000.
It's going to be 25,000 because one, when you go read the scenario, first thing you need to recognize is the estimated number. Second thing is, did you see the word total credit sales? Then boom, all you need to remember is just the estimated number. Okay? Simple, easy. All right. And that's it for chapter 10.1. Okay. So here, I'll give you a little review here. That's kind of important, and it's also easy for you to remember. So two things you need to remember is what accounts receivable does. It's essentially when customers, you place a sale and they owe you money for it. And then when you use the allowance for doubtful accounts account, you use it during the year, assuming that your customer decides to fault on their payment. So you can have a debit balance, you can have a credit balance, because sometimes if you know that this person has a potential to pay back, that's exactly why you have a balance in your allowance for doubtful accounts. You can have a debit balance, you can have a credit balance, because the assumption is that it's a temporary placeholder. There's always the possibility that they will pay, okay? And that's going to be considered, it's a contra account, and it happens during the given period or during the year. Once you've exhausted completely everything and you see that you still currently have a balance in your allowance for doubtful accounts, that's where at the end of a given period, whether it's at the end of the month or at the end of the year, that's where you're going to create an adjustment entry to write off the bad debt expense or write off that loss that you're not going to collect that money. So in this case, when you create the bad debt expense account, that's where you're going to do bad debt expense and you're going to credit your allowance for doubtful accounts. Okay? And then, of course, with context, there are two ways that you can write off bad debt. We have the direct write-off, which is directly taking it off, which is from the accounts receivable, and that's only used for tax purposes only. Where the one that we're supposed to learn, because you're not the tax accountant, is you need to be able to follow the allowance method, which we know the allowance method is broken down into two categories or two more methods. We have the balance sheet method and we have the income statement method. So again, three things you need to know when it's the balance sheet method. You need to know the estimated amount, the word account receivable, and you need to know what balance there is in the allowance for doubtful accounts. If it's debit, you add. If it's credit, you subtract. Whereas on the income statement side, all you need to recognize is there an estimated number and the word total credit sales. And of course, when we look at the journal, they're identical for both methods. Okay, you're still going to be debiting your bad debt expense and you're still going to credit your allowance for doubtful accounts. Okay. Any questions in regards to chapter 10.1?
So when you offer accounts receivable, do you check also the credit score?
Absolutely, because remember, in order to even be eligible for an account, oftentimes what happens is that you are telling your customers, hey, verify with me your credits, verify me your social security, right? No one's just going to give you a free account just cause. They usually, unless it's like one of those, free sign up and you get an email and you have an account with us, then that's different. Or if you are signing up on an online server and you're not using a personal credit card, then you have an account with them, right? Because it keeps records of what you purchase and whatnot. That's kind of separate than what it is when you're dealing with someone that actually owes you the money. Okay, so you have to also make sure that they have enough credit or their credit score is high enough to allow them to be able to give you proof that they can owe you money. Because ultimately, you can't just give anybody a credit limit, right? You can't just assume that everyone's going to pay you 100%. We have some people who are out there that they intentionally fraud, or scam companies by buying a whole bunch of stuff and just never ever paying them back. Sad, but it does happen. It is a real life. It happens in real life. Okay. So yes, most cases, if not, because I've never heard of someone just giving a free account randomly with a credit limit. Most likely, if the customer's going to owe you some form of money, you're going to definitely check the credit score. Okay. All right. Any other questions in regards to chapter 10.1? All right, then. Okay, so let's go ahead and do the chapter 10.1 exercise. So here's the allowance method. All right, so here you go. Number 1. On December 15th, okay, Robert buys a total of 100 coffee mugs at $9.99 each on account. Sales tax is 8.375%. Go ahead and do this one because again, in context, it's given this way. Okay. Okay, so good. The date is December 15th, and you said accounts receivable. All right, what else? Sales, good. And what else?
Sales tax.
So what's my total sales here?
999.
990.
$9.99.
9. So 1, 2, 3, 9.99. All right, good. How much tax is going to be on this?
86.67.
80.
83.67.
Okay. And how much does he owe me in grand total? That's using the yes. Good.
1082.67.
1082.
2.67.
Good. All right. Good. So that's how much Robert owes me. So I'm going to go ahead and make sure that I also indicate in here in my notes that Robert, the account number is under Robert. And he purchased 100. Or, sorry. What was it? Sold 100 mugs to Robert. Okay. So then question number 2 goes on January 15th. Robert sends a check for $25. How do you generalize that?
Allowances for debit.
No. See, he sends a check. What does that mean for $25? What is he doing?
He's paying.
He's paying. So how do we record that he made a payment?
Sales.
We already journalized his sales. Okay, if he's making a payment to what he owes us, how do we journalize this?
Payable.
Not accounts payable. We don't owe, he owes us, not we owe other people.
Accounts receivable.
Accounts receivable, but where would you put accounts receivable? Would you debit the accounts receivable or would you credit the accounts receivable? Credit. What did we receive in exchange?
A check.
Yes, we received money. Obviously, we received money. We better increase our checking account. So in this case, yes. And we're reducing the amount that he owes me, right? All right, and we're gonna reduce it by $25. Okay, and in this case, I'm gonna go ahead and say that Robert paid. Or actually, let's do payment from Robert. There you go. Payment from Robert. Okay. So then on February 15th, Robert informs us that he can no longer pay due to his financial circumstances.
Credit allowance for doubtful account.
Good. So this is February 15th.
Yes.
We're going to debit the allowance for doubtful accounts because he informs us exactly when it happened, right? But that doesn't mean right now he just says, "Oh, forgive me. I can't make this monthly payment because of my financial circumstances." So we're like, "Okay, that doesn't mean he's gone for good. That just means he cannot make this payment now." So what I'm going to do is I'm going to place him in the allowance for doubtful accounts, or what he owes me for the allowance for doubtful accounts, because he has the potential to still continue making payments, just right not now, because I don't know how long his the financial circumstances is going to be. So I'm gonna go ahead and do that. And then what is my credit account?
Accounts receivable.
Yes, we're reducing his what he owes me. Now, if in this context here, right, if I started my account balance at $1082.67 and he made a $25 payment, how much does he actually owe me right now?
$1054.67.
1054.67. So let me see. 25.
I have 1057.67.
Yeah, 7. Yeah, I just went back to double check because let me see. Okay, so the 67 cents, but 5 minus 2 gives you 7. Yes.
Yep. Sorry.
No worries. That's why I always encourage you guys to work together and help each other out, help each other out with calculations. All right, so 1057.67, and in this case, I'm gonna write here Robert, just Robert's accounts receivable, whatever you want to name it. Okay. So then on June 15th, okay, so a couple days later, Robert decides to pay, says that he can pay $25 this month and sends a check.
Checking.
Now, first off, where is Where is the amount that he owes us? Where's his accounts receivable at?
And allowances for doubtful accounts.
It is an allowance in the allowance for doubtful accounts. Now, in this context, you cannot pay directly from the allowance for doubtful accounts. So what should you do if you can't pay directly right out from the allowance for doubtful accounts? Because remember, that's the placeholder account. So what do we have to do?
We add bad debt.
Not bad debt. This isn't the end of the period yet. We're not ensuring that we're not writing off that he's not going to pay us completely. He made another $25 payment.
Go back into accounts receivable.
What are we putting back in accounts receivable?
The 1,057.67.
Yes, we're going to have to revert the process because again, the assumption here is that we're reactivating his account. So same thing when we apply in real life, right? When someone you know tells you that they can't pay you, you put them on the side. You deactivate their account because you know every monthly that you create your profits, you can't count him. So now that he is making another payment, you have to reactivate his account. So in this case, you're going to have to reactivate that by re-entering it in from the accounts receivable. So in this case, I'm going to debit my accounts receivable because what I'm going to do is I'm reversing the transaction because I'm reactivating his account. And I'm going to credit my allowance for doubtful accounts. Okay. Yeah. Okay. And it's going to be for the whole amount. You're not going to take just $25 out because again, we see that he's becoming active again. So therefore, maybe June is not the last date he's going to pay. July he could pay. August he can pay, right? That's the assumption here. So we need to activate his entire account by reversing this amount. So we're going to reverse the 1057.67. Okay, we're going to reverse the amount. And then now we are able to validate the payment. So what did we receive from him?
Check.
Check.
Yes, we received a check and it's going to go straight to our banking account, right? And then we're going to decrease the amount that he actually owes us. Okay. So again, we're going to decrease it by $25. Okay, $25. All right, and in this case, Robert, payment from Robert. Okay, so that's that there. So then now on July 15th, Robert actually files for bankruptcy. Okay. And the bank collector informs you that he can no longer pay. So now what we can do? What do we do here?
Bad debt.
Say that again?
Bad.
Debit, bad debt.
Okay, so this is an actual amount that we know. So does that fit the category of a bad debt?
Yeah.
What are the three things that we...
Bankruptcy.
Okay, yes. So we can guarantee that he can't pay us. But the question here is, are we at the end of a given period or are we in the middle of middle of a period?
End of the period.
We are not at the end of the period. It's July 15th.
We're in the middle.
Middle. Yeah, middle.
Okay? Second of all, you know exactly who. Right? You know it's exactly Robert. So that does not fit the category of the bad debt expense. And you know exactly how much. So in this case, can you use the bad debt expense?
No.
No. All right? So what are we going to be journalizing here? If he has filed for bankruptcy, okay, and the bank collector tells you that he can no longer make his payments, and you know that's a bad, it will potentially become a complete bad debt that you have to write off. What is the journal entry that you're going to be journalizing here?
Allowance for doubtful accounts.
Yes, you need to replace them into the deactivated accounts, right? Obviously, in this case, because remember, we reactivated him up here because he was showing tendencies that he will potentially pay. But then now that we for surely know he's not going to pay anymore, and you got a bank calling you saying he ain't going to pay anymore, then that's where you go ahead and say, okay, well then it's during the period. So I'm just going to recognize that he is going to be, he will be one of the individuals that are going to be written off as a bad debt. But right now, we're in the middle of the given period. We can't just write it off right then and there. We have to wait till the end of the given period before we can write it off, okay? So in this case, allowance for doubtful ACCT. And this one is taking it right away out from accounts receivable. Okay, so how much does he owe me now?
1032.67.
1032.67. 1032.67. 1032.67. Okay, and again, okay. Now, it's December 31st, okay? And your company makes an estimate that $2,590.54 of its 29,475 and 72 cents accounts receivable are uncollectible, okay? Including Robert's debt. And you have a total credit balance of $157.62 in the allowance for doubtful accounts, okay? Now, of course, remember, our company decided to tell me this. Is Robert my only customer?
No.
No. How in the world did I how in the world did I get $29,000 of accounts receivable if Robert was my only customer? Okay? So this number is based on your whole entire group, okay? So in this case, the 1,032.67 includes it in this pile right here because again, your allowance for doubtful accounts doesn't just hold Robert's account; it holds other people's accounts as well. So in this case, right, it came down to we kept changing it there, changing it here. Remember when we saw in the scenario, right? We debited it at first, and then we credited it again, and then we debited it again. So again, Robert's not my only customer. So in this case, now that I have this assumption here and my company gave me this information, you currently have a credit balance of $157.62, which includes Robert's debt. Okay? Now, how do I journalize this?
Bad debt expense.
Okay, so December 31st. Yes, because we reached the end of the given period, right? Another thing, too, is we have an estimated amount, right? We don't know who. Bad debt expense. And then what is going to be my credit account?
Allowance for doubtful accounts.
Yes, allowance for doubtful ACCT. Okay, now let's look at this. What method am I using? Balance sheet or income statement?
Balance sheet.
All right, so then go ahead, let's calculate. Then tell me what is my total bad debt going to be?
$2,590.54.
No. We're doing the balance sheet method. What are the three things that you need to know when you're doing the balance sheet method? We have the good.
The
What else?
accounts receivable.
Accounts
and the
receivable.
balance.
So do we have a balance in the allowance for doubtful accounts? Yes, we do.
Yes, we do.
Is it a debit or a credit?
Credit.
Okay, so what do you need to do?
Subtract
Okay, so go ahead and do that.
2,432.92.
2,400, what was that?
32.92.
32.92.
I'm not sure. Yes.
Oh, okay. Well then, anybody else that's got that can confirm?
Yeah, it's right.
2,432, 2,432.92. All right, and that is how we deal with allowance for doubtful accounts during the year, and how it gets to the point where it comes to the conclusion where we reach the end of the period. That's how you get a balance in your allowance for doubtful accounts, right? You're dealing with customers left and right. And in this case, we saw what happened during the period, right? We saw that how you create the balance in the allowance for doubtful accounts. And then here at the end of the given period, when this total amount is completely estimated and you're going to write it off, that's how you do it. And you take it directly out from the allowance for doubtful accounts. Okay. All right, so let's go ahead and continue. Now, the next following questions are not going to be related to questions 1 through 6. So let's go ahead. Number 7, a company estimates that 20,000 of its 500,000 accounts receivable are uncollectible. Okay. There is currently a debit balance of $5,000 in the allowance for doubtful accounts. So how do we journalize this adjustment?
Bad debt expense.
Bad debt expense.
And then allowance for doubtful accounts.
Good. So I'm just gonna go. Yes, and I'm just gonna go ahead and copy it from up here. Okay. And here you go. All right. And then what is going to be the amount that you're going to place in here?
25,000.
25,000. So how did you figure that out?
Because we have an estimate of 20,000 and a balance of debit balance of 5,000. You have to add it together.
Good. All right. Next scenario here is a company estimates that 20,000 of its $500,000 total credit sales is uncollectible, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts. Journalize this entry. Okay.
So it's the bad debt expense,
Mm-hmm.
and then it's also allowance for doubtful accounts,
Mm-hmm.
and it is for 20,000.
Good. This is the income statement method because we see the words total credit sales. Okay. The next question here, number 9, a company estimates that 20,000 of its 500,000 total credit sales are uncollectible. Okay, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. Record this adjustment.
Bad debt expense.
Mm-hmm.
Allowance for doubtful account.
Mm-hmm.
20,000.
20,000. So again, this is another income statement method because we see total credit sales. All right, last but not least, question number 10. A company estimates that 20,000 of the $500,000 accounts receivable is uncollectible. There's currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
It's a bad debt,
mm-hmm,
allowance for debit account,
mm-hmm,
deb- and we're gonna minus
yes.
20,000 minus 5,
So what does that give you?
15.
Good. $15,000. So like I said, this is that's as far as I'm going to teach you. Is I'm only going to teach you the bad debt section, so you don't need to really know the allowance section really much. Just know that what allowance for doubtful accounts is, like what does it do? It decreases your accounts receivable. It's a contra account, and it happens in the middle of a given period. So it's just basically when someone just tells you I can't pay, you just write it, you just put it there for now. It's a temporary placeholder. Until we reach the end of the period, that's where you need to make an adjustment entry to write off that bad debt as a loss. Okay? So good job, everybody. So that was 10.1 for you. Any questions? Okay. No questions?